Putting cash to work over the past month has mostly resulted in investors getting burned in the short term, but our next guest says there are some pockets of this market that could help protect against inflation. With us now is Peter Kraus, CEO and chairman of Aperture Investors. Peter, good to see you down here.
Good to see you, Mike. It's great to be here.
Just this environment, it feels like we doesn't know what temperature we're going to be at for a while, or to change the metaphor, hard versus soft landing. Each day it seems like leaning in one direction or the other.
Yeah.
Where does that leave you in terms of the outlook and how you would want to play it?
I'm not a fan of soft landings, meaning I just don't think you can engineer them. The markets tend to overcorrect. They don't smoothly go down or smoothly go up. So you have to sort of expect that we're going to attack inflation. The Fed's been completely clear about that. We're repricing assets. We're repricing equity assets. We're repricing debt assets. And the move is not going to be smooth. And so there'll be volatility, which we're seeing. And you're going to be confused, if you look at every day and try to figure out what the trend is.
In some respects, based on all of that, this is the intended consequence of what the Fed wants to happen and where we are in the cycle. I guess really the critical question is, where are we in that process? How much of it are we closer to the end, the beginning, or not?
Well, I'll just give you a point estimate. We're probably two-thirds of the way there.
Okay.
I think that we're likely in some kind of recession, certainly an economic slowdown right now. We don't see the numbers yet, although the leading indicators today were much lower than what had been anticipated. So there's some evidence that that's the case. Oil prices are elevated, but they're not continuing to go up.
Yeah.
So my guess is that the economy is slowing down and consumers are spending less. And we could actually, in retrospect, look back at this and say we had a modest recession.
Yeah.
So we're probably there. And in terms of two-thirds, the market may have another third to go, but It's tough to be smart enough to know when you're at the bottom.
Exactly. Along the way, on the way up, a lot of people went into a lot of different pockets, private markets. You heard a lot. Love private credit. That was a mantra for a long period of time, private equity even. And so there's some unwind there, but it's not really as obvious as to how it's happening in real time. And so what about that world?
Well, the great thing about private markets is they are a little bit slow motion. And so, that allows them to take a little more risk and to be a little less susceptible to market volatility.
Yeah.
Having said that, when you're in a regime like this where you are literally repricing interest rates, this is not like interest rates go up 25 or 30 basis points. We are repricing the entire interest rate.
Mortgage rates doubled, basically.
Yeah, we're repricing the entire interest rate complex. So when that is happening, assets have to get revalued. Mm-hmm. And private assets have to get revalued. Private credit has to get revalued, and private equity has to get revalued. The revaluation process in private assets is always slow. It lags. Mm-hmm. It's usually 3 months to 6 months. And if markets recover quickly from here, you won't see that much of an effect.
No reckoning, yeah.
But markets may not.
Mm-hmm.
And markets may continue to be languishing for the next 6 months. And if that's the case, you're going to see marks on private equity and you're going to see marks on private credit. And where there's leverage, there'll be some stress.
That would suggest being a little bit patient, maybe just sort of keeping cash in reserve. But what about real estate? Is that someplace you feel like isn't out?
Well, I think real estate's very interesting. I've said on your program before that multifamily real estate, where you get rent increases and you have pretty good vacancy or low vacancy rates, is a good inflation hedge. Office properties are challenging because of COVID, and nobody knows what the marginal use of the office property is going to be. But multifamily is a pretty good bet. Hotels, because people are going back and traveling. So hotels less of an inflation hedge, but in the multifamily space where you have rent increases, that's an interesting inflation hedge.
Yeah, it's considered a problem for the Fed, but it could be good if you actually own the assets, I guess, when we're talking about multifamily. Peter, great to see you.